On today's hot sheet, I'm discussing housing inventory for the week, existing home sales, and Realtor.com's latest rental report. Today is Monday, September 23, 2024. I am Byron Lazine, and the hot sheet starts now. Good morning and welcome into today's hot sheet. Let me know in the live chat which market you are tuning in from. I'm tuning in from my Naples, Florida studio. We've got a lot to go over today. A little bit of housekeeping here up front, but there's so much data pouring into today's hot sheet from obviously the end of last week and then the start of this week. I apologize first off for missing last Thursday. It pained me greatly to miss the Jerome Powell show, the 0.5, the half a point rather reduction off of the Fed target rate. It was a great day. I know a lot of us are rejoicing. I'll give you a little bit of my thoughts here before we get into today's topics. But first, I want to announce a partnership we just did with Zoodealio. Zoodealio, as you can see here, the hot sheet for the first time ever is now powered by one of our great partners. And I'm not going to say much about this partnership yet because next week we have a major announcement for BAMX members that involves Zoodealio. So I guess that's all I'll say now. If you're not familiar with Zoodealio, more to come in the future. BAMX members, you will all greatly benefit. Of course, you can get into BAMX today by using code HOT to get 10% off your BAMX subscription. So BAMX members, a lot to look forward to, but everybody that follows the hot sheet gets value out of what we do at BAM. There's a big announcement coming with Zoodealio. It's going to change the game. It's coming in just a week. So stay tuned for that. All right. Before we get into the inventory update, I do want to chat about my thoughts on Jerome Powell. Obviously, I was a fan of a half-point cut. A lot of the mortgage rate reduction, 30-year fixed, has been priced in already. So we're not expected. And in fact, on Friday, it went up a tick, right? We're still in the low sixes. But a lot of this was priced in. We knew that. We said that before Thursday happened, before Wednesday afternoon's announcement. Okay, we said this is priced in. There's not going to be a huge movement. We can gradually over the winter get into the high fives, that 5 3/4 range on the 30-year fixed. That's going to be a good thing, right? But what Jerome Powell said to me was always going to be more important. And I know Jeremy did a great job covering what Jerome Powell said, and in the hot sheet show notes, obviously, for those of you that are BAMX members that have access to that, all of the timestamps are in there. He actually addressed housing, and there was housing questions more than any meeting I can really remember. All those timestamps and data points are in Thursday's hot sheet show notes. So you have access to all of that. What I thought, though, was really important was what he said, particularly about where we are with inflation. Okay. I guess the video froze, but the sound is good. So thank you, Dawn, for saying that. I will see what's going on here. It looks like the video is still frozen here. I don't actually know what I can do to fix it. My video, just for Bobby's sake, my video on my confidence monitor is still working, but I do see that the StreamYard is not working. So not a camera issue. Anyways, I guess we'll have to go with the frozen look. Yeah, there we go. It's still frozen. Bobby, if you've got a fix for that, let me know. It sounds like they can still hear me, but I'll continue here with what Jerome Powell said and what I thought was interesting from his comments on the economy. He said, we are getting down to inflation where they're confident it's getting down to 2%. So he's saying, hey, we've beat inflation essentially. At the same time, if we beat inflation, he's saying we are concerned, or not necessarily concerned, but we don't want to see labor get through or get softer, right? We want to protect the labor market. But the 0.5%, if they feel confident about inflation, the 0.5% rate cut was an aggressive one. Listen, I champion that. I think we've been beating inflation down for quite some time in the metrics that they use, particularly owner's equivalent rent. I know he addressed that. I know Jeremy talked about that question and answer there. But uh, you know, if the inflation was good, then why not go a quarter point, right? Unless you're a little bit more worried about those jobs, unless you see some, you know, retraction in the economy in the future. I'm not sitting here predicting a recession. I'm just saying it was interesting to note that they did this cut primarily because of jobs. So what does the Fed see in the future? I guess would be my biggest question. I did appreciate all the housing conversation though, and he can't figure out housing. He said that again, and so there you go. That's my recap. I know Jeremy did a great job. You can watch the replay and you can grab those hot sheet show notes. Okay, let's dive into this week's inventory. Obviously, I don't know what's going on with this video. Bobby's, I don't know, Bobby's maybe taking a break.
No, everyone. Byron, if you could just quit and rejoin. I think we're just having some issues with the StreamYard backend. We'll be right
Bobby,
back, everyone.
I will do what Bobby says.
Apologize, everybody. Byron will be back in just 1 second.
All right, looks like
And we're back.
we've got the visual there. All right, let's get into the weekly inventory here as promised. Okay, getting into it from Altos Research for the week. That is not the one I want. Neither is that. There we go. In fact, neither is that. All right, here we go. Here's the week inventory change from September 13th through September 20th. Across the U.S., you have 713,000 a week ago, rising to 725,000. So 12,000 increase on inventory. Inventory from the same week a year ago did increase just about 9,000. The interesting part of this is if we look back to normal markets, we typically start to see flattening or a decline, right? In 2017, 18, 19, the three lines at the top. At this time, even months before, 30, 45 days before, we started to see a true flattening out of inventory and even a decline before the seasonal, more rapid decline takes place. We're still on the up and up here. We are still increasing, moving up. When we had the holiday step back, first week of September, we saw, our first decline in some time from really just more, I would say, flattening from 704, 300 plus on active inventory to 703, 600. That's hundreds of homes for 300 million plus population. That is nothing. Now we're back on the gain train, which is really interesting because how much closer to November when things really typically start to drop, and obviously we've got some things going on in this country that impact us all in November. How much more can we gain on inventory? How much closer to that number that I really wanted to get to, which was the beginning of 2020. When we start January 1st of 2020, we were at 763,000 on active listings. In January of 2020, nobody was saying, hey, we're going to go into one of the most, restrictive inventory times in the history of housing, because nobody could predict what was coming in March of 2020. So 763,000 to start 2020. January 2020 obviously continued to go down, as it will January and February before the spring season comes up, and then obviously 2020 was just a weird year altogether, what happened in the second half. But that number, if we get to that number at any point this year, I think it's a big marker for inventory. I think it's a checkpoint that we can check off, saying, hey, we got back all the way to where we were at the beginning of 2020. Now, what Jerome Powell says, what many analysts say about housing is, well, that's still short to meet demand, especially in affordable. We're still way behind because of the decade of recovery after the GFC. All of that remains true. But getting back to that level, I believe, would be somewhat of a win to celebrate. We're now at 725,000. What we talked about last week, was last week's inventory gain going to be just a bump after the holiday. Now you're seeing 2 weeks in a row of those bumps, so starting to feel like we're back on track. How long will it last? is the interesting part. We've got 37% more than last year. If we look at 2019, super normal market in comparison to today. At this point, we had 963,000. So that gap is starting to get smaller as well. We're what we're accustomed to saying is 300,000 plus is now under 250,000 between September, same point in 2019, and today. Still a big gap, but 37% more than last year at this point as well is also a big gap. So we're making moves on inventory, making moves in the right direction. One of the things that helped the most here in this last week in particular was new listings, new single family listings across the country came in at 70,000. That's above obviously last year's mark, which last year was the lowest level ever recorded, as well as 2022, which came in at 63,000. And you can see on the chart that we're actually the last few weeks really popping on new listings, probably with the most momentum we've seen at any point this year. Okay, we're almost at a high for the week of any week this year. There was a week in August where we had 74,000. So this is like tied for the second highest new listing week on the year. Obviously you've got a bunch of them that just barely broke 70,000 in June, July, May timeframe, when you're really into that heavy selling season, when most sellers want to be on the market because most of the buyers are out there. And now all of a sudden you're getting back to that level. Typically, look at this. I mean, you see a real decline that's already started on new listings and continues throughout the year. We're going the opposite direction of what normally happens on new listings right now. I'm not predicting that it's going to continue. I'm saying that's something interesting to note. And if it continues into next week, talking now the last week of September and into the first week of October, that's where it's going to get really interesting, because October, November, December, you see new listings decline each and every single year. If we go against that trend, that means we're going to have more inventory coming into next spring market than we probably expected 12 months ago, even 6 months ago. And if we get a lowering of the interest rate, you could just see more, a fluid movement in the market. I've also shared on this that I think if you really had that equilibrium number, like closer to 5, I'm not saying we're going to get close to 5 in the 30-year fixed come the spring, but if we did get closer to 5 and we were seeing inventory increase, you might actually in the short term, because there'd be so many people moving at that point that have been sitting on the sidelines for a while, you might actually see prices stall for a period of time before shooting back up. Obviously, bringing all the buyers out to the market that have been on the sidelines, restricted by affordability, is eventually going to push prices back up. But there might be that moment in time. I still believe this winter is the best moment in time, because you're seeing it, inventory going up. Now, while we're seeing more buyers come out right now, it's not to the level of the spring. This is a particularly interesting point right now for buyers to be negotiating with those sellers who are on the market before the end of the year closes out. Percent of properties with price reductions here the last week came in just under 40%. So 39.9, that's a little less than the week before at 40.1. So interesting there that number is not going up as it did in 2022 and 2023. At this point, it went up considerably, on this level. Right now, we're more on a flattening on price reductions. Obviously, price reductions coming in higher this year than at the same point last year. Typically see a third. We're above that number as well. Total sales now, total single family or total home sales rather, pending in contract right now, or in escrow, however you want to use that phrasing. We're at 4.5% more single family homes in contract than we were last year. That's 360,000 just above. And again, good for 4.5% more than last year, but below the 2022 levels when we were at 390,000. So pending sales starting to improve off of last year's marks. Last year's marks come this time of year and throughout, the fourth quarter, got pretty low. 4.5% is, a number that we'll take right now. We'll see if this number, with where the rates are, can push us up past where we were in 2022. Could we cross that line, here in the coming weeks with 2022, and continue to see homes going under contract in a fourth quarter when you typically will see them decline. And we're working off of really low levels, so there is room for upside on pending contracts. I would imagine everybody would welcome that. Okay, one of the other interesting parts here to be monitoring, obviously, with everything that's going on with the Fed cuts, the good feeling that has brought to the economy overall. Now, we know that hasn't done much to the 30-year fixed. I think that was important to be educating your clients, your customers, the week leading up to the cuts. So now you can put, hey, like, this has been priced in. And there have been moments when we've, just going back the last 2 years, there have been moments when we've hit these lower levels, when we've gone right back up. And because that spread can change, we see these lines here, spread between the 30-year rate and the 10-year treasury yield over the last better part of 2.5 years has been pretty volatile. Now we're at the best marker here that we've seen in 2 years on the spread between the 30 and the 10 years. One of the reasons why we're in the low sixes and not at 7, we'd be near 7% if we were just the same level that we were at in 2023, when that spread was, at this point, it was closer to 2.82. The spread right now is 2.42. We got to get closer to under 2, like 1.75 to get back to historical norms. For this to be really, normalized, which means we could get a 30-year fix coming in quite easily with normalization of this spread to like 5.75. That's kind of where, if we're just basing it off of what the Fed is saying and things kind of stay status quo and these projections come in, that's kind of where we expect to be at next spring, is like 5.75. Again, this is based on projections that can change, based on, Fed movements, which can change. All of that can change, but should it hit the trend line that we're on right now, hey, 5.75 is a real possibility for a spring of 2025. I know that's not 5%. I know that's, not 5.25, which buyers would be much more comfortable in those ranges, especially the locked up, sellers who would be buyers would be more comfortable if they get down to 5. But if you're at 5.75, you're not that far away from, if you're financially stable and able to do this, to buy down that rate. Okay. Just the rates here over the past year. Okay. So purchase applications we've seen have gone up, the last couple of weeks, or have seen some positive movements on purchase applications because of this spread getting better, because of the 30-year fix going down. And when we look at purchase applications during, pre-June, let's call it, during the higher levels of the year, you have 14 negative prints, purchase applications going down. We talked about that year over year from 24 to back to 23, back even to 22. We saw less demand, less mortgage applications before June, July, when interest rates kind of topped out there. You had 14 negative prints on mortgage applications, 2 flats and 2 positive. The 2 positive obviously being like in the spring, when it was like peak spring time frame. Okay. When purchase application looks like, since mortgage rates started to fall, this is going back to mid-June. So since from mid-June to now, we've had 10 positive prints and only 5 negative prints. So as rates get lower, demand is coming back. Okay. We're seeing that. And so, that's another indicator that, okay, demand is coming back now at a time of year when buyers, for a variety of reasons, holidays, this year, election, back to school, all these different things, don't want to be out buying in the fourth quarter, even the beginning of the first quarter in any given year. You can track this back 20, 25 years in your own MLS and see the data. It's striking. You can set your clock to it. Take 2020 out because it was such an oddity. But you can show this to buyers and be like, hey, the demand will be here in the spring, as it always is. In a 12-month cycle, it'll be the strongest, right? And if we're going to continue to get lower 30-year rates, just as this data shows us, these positive prints, they're going to dramatically improve in the spring. I really believe in educating them to make sure that they understand that, so that they don't miss these opportunities. They don't look back on what, prices look like in December and January for the smart buyers who were out there in October and are disappointed in the spring, because they shoulda, coulda, woulda. This one here shows it. Finally now, mortgage purchase application, I mentioned this last week, is like even with where we were in 2023. This is the first time in 2.5 years that we have a year-over-year reading on mortgage purchase applications that is even, that is flat with the year before. So I get it. We're at like an all-time low when it comes to demand, or near that. But we're starting to now see a trend. And this is a multiple week trend. As you look at the dot chart here, this is a multiple week trend, going back 3 weeks, where we're now getting to even on mortgage application prints year over year. First time in over 2.5, maybe even 3 years, obviously, on this data, as you can see here in front of you. So good positive signs coming right now into housing. Now, how much of the economy is going to be at risk for us to be getting these, good reading, all of this good data that we like to see? Okay, lower 30-year fixed, more people coming back into the market. When I say how much of the economy is at risk, like how much GDP retraction for the Fed to be going this aggressive now on the 0.5 point, is there going to be in the future? How much job uncertainty, or softening in the job labor market is there going to be for the Fed to do the 0.5 point? Remember, they've been very hawkish in past meetings, and now flipping all the way to a 0.5 point. When we went in on Wednesday morning before Jerome Powell spoke, Wednesday afternoon, that CME Fed watch was basically at 50-50. Like it was a coin flip of what the Fed was going to do. It was a near unanimous vote, 11-1, to go to 0.5 point. And so, I mean, you could have made a very strong argument that a 1/4 point would have been fine. If you look back on, take 2020 out, they did a 0.5 point cut there, but the other times they did these 0.5 point cuts was 2001, 2007. We know what happened after that. In both situations, the last 3 times they did a 0.5 point cut, the 01 and the 07 timeframe, the stock market went on to lose double digits in the next couple of years. We're talking 25, 30% losses in the stock market after the Fed did a 0.5 point cut, because the Fed did that 0.5 point cut knowing we were going into, 01 after the dot-com bust, and then obviously in 07 after the great financial crisis, the mortgage pop there. The Fed knew we were going into some really hard times and wanted to be super aggressive. Now, 2020 emergency 0.5 point cut, we know what happened there. The federal government dropped trillions of dollars down onto the economy, and the stock market obviously went way up. What do I think about this stock market? I think that I'm going to be cautious. I think there's a lot of reasons to be cautious. I'm not calling for a recession. I said that before, but there is reason to be cautious going into next year at the state of the economy. We've talked about these now for the last few months. And in fact, when the Dow hit the record, let's see where the Dow is today. Actually, I'm kind of interested because I've been watching it the last few days. When the Dow hit, so Dow's basically coming in flat here today, just down a couple ticks here after opening bell. S&P up slightly, NASDAQ up slightly. But when you saw records on last week's momentum in the stock market, this is not financial advice, but I'll just tell you what I did. I took some money off the table. I sold some Zillow. Zillow went to 52-week high. I sold some Zillow stock up about 30-40% from where I bought for the first time in a long time. Okay, I sold about 50% of my Zillow. Sold some of my Meta, Facebook. Sold some other, just in my Fidelity, not what I do with my, this is like my play one, right? So not what my professional financial advisor is doing, but just what I'm doing with my own Fidelity app. And looking at it, I'm like, you know what? I'd rather have some of this sitting, or 50% of this account sitting in cash right now, because it does feel like how the CME group felt. It is feel like a coin flip that like we're going to go into maybe some type of um, you know, pull back on the recession. I mean, they could print a whole bunch of money. It could completely rip too. I think asset prices are safe, right? Meaning the homes, that those are going to be pretty safe investments, especially for the long term. But we'll see what happens here. And I think the fact that the Fed just went pretty aggressive here, you see a lot of people online are trying to spin that to be political, and they're doing it because of the November election. And that's some people's beliefs. But the other, I'll just take Jerome Powell. What he said was, hey, we're concerned that, about the labor market, and we want to make sure nothing happens there. So I think that's, worth paying attention to and listening to exactly what he said on that. All right, let's take a look at existing home sales now. According to NAR's release, existing home sales for August came in at 3.86 million. Now, that is well below the floor that we believe we can never really dip below, which is 4 million. We're at seasonally adjusted annual rate of 3.86 million. These are all-time low numbers. If you calculate current population, these are all-time low numbers on existing home sales. Obviously, existing home sales is a lagging number, but when of activity, and we see more activity right now, so maybe these numbers improve when we look fast forward 60 to 90 days. Month over month, though, down 2.5%. Year over year, down 4.2% on existing home sales. Inventory now up to 4.2 months, getting closer to 6 months, where neither buyer nor seller will have a clear advantage. And, on the way up, there are markets where it feels like buyers do have the advantage. South Florida, some areas in Texas, as we've identified, right? But 4.2 months across the country. It was just 3.3 months back in August of 23. Obviously, median sales price continued to rip year over year, now at 3.1%. So you see a deceleration continuing in appreciation. I expect that to continue throughout the fourth quarter, and 416,700 on median sale price, according to NAR. Looking now at the August 2024 Realtor Confidence Index survey, there's some interesting stuff here that was part of this release. 19% of respondents expect year-over-year increase in buyer traffic in the next 3 months. So that's up from 16% a month ago and 11% from a year ago. So more, realtors are confident right now that we'll see an increase in buyer traffic over the next 3 months. The next 3 months are, this is August report. So we're talking September, October, November, when you usually see those numbers recede, but the rates are obviously having a lot to do with that. 18% of respondents expect year-over-year increase in seller traffic in the next 3 months. So realtors are just more confident right now that there's going to be more overall interest in the market. Can't go any further down, though, obviously. So taking that into consideration, 60% of respondents reported that properties sold in less than a month. This is down from 62% just a month ago, and 72% in August of 23. So days on market, obviously the months of supply is one way to look at it, but days on market also trending up in most markets across the country. At the time of year also is something that, speaks to that. Okay. Contracts typically close in 30 days. 5% of contracts were terminated in the last 3 months. That's flat from 6% 1 month ago and 5% a year ago. So you're not seeing terminations really, according to this realtor survey, go up. 14% of contracts had delayed settlements in the past 3 months, essentially flat again from last month and from a year ago. 6% of contracts were delayed due to appraisal issues. Okay. That's actually down and then up slightly from a year ago. Interesting. I was at the Jared James Advance. I spoke at it the end of the week, which is why I couldn't be here on the hot sheet on Thursday. I was actually speaking at the time we go live. And another speaker who I've interviewed on BAM, Nick Bailey, former CEO of Remax, just took a executive position with T360. He said something pretty interesting from the stage, so I feel like I can share it because he shared it publicly. He's of the belief that appraisals are going over the next 3, 4, 5 months are going to become an issue because of the way contracts are being negotiated. So if Nick's right, this number, we'll track this number, right? But if he's right that because of the way commissions are being negotiated into appraisals, we're going to see appraisal issues going up, like contracts being delayed due to appraisal issues. The way, he made it sound, hey, next 3, 4, 5 months, we're going to see a significant increase. I would expect this to go above, any of these numbers, 6, 7%. I'd expect it to get up closer to 9, 10%, maybe. If, I don't want to misquote him, but, I think he used these numbers and threw out a double-digit number as a projection. I don't have notes in front of me, but he is calling for a substantial increase on appraisal issues due to the negotiations of commission being moved into the deal. Something that I think will be interesting at the very least to keep an eye on, if that, as we move forward over the winter, if this number on appraisals moves up, or with the appreciation that we do have, albeit decelerating, that kind of gets washed away and it becomes a non-issue. Market dynamics in an appreciating market, but probably wouldn't matter as much, but you also have more compression on commission in some of those markets from time to time if they're highly competitive, obviously. First time buyers represented 26% of buyers. Okay, that's down from 29% in July. 19% purchase for non-primary resident use. That's up from 13% last month and 16% a year ago. Interesting. 19%. So you're seeing investors or second homes. 7% were vacation use. So there you go. So 7%. That's up 4% from a month ago, 5% from a year ago. That's an interesting increase. 2% of sellers sold to an iBuyer, essentially unchanged from 1 month and 1 year ago. That's about the market that will capture. 1% of sales were distressed, flat from 1% 1 month ago and 1% a year ago. Remember when Brad Inman said this was going to be 50% of all sales, and it still remains at 2%? I remember that because I did quite a bit on the Real Word Pod on that. All right, there you go. There's your confidence score from Realtor wrapped into that existing home sales data. Thought that was interesting there on August. I did say that we have the Realtor.com rental report, which is showing rental affordability. I'm going to bump that to tomorrow. Here, I've got a flight to catch, so can't go past the hard stop of 30-minute show. And I know everybody, all of you guys, have a lot to obviously get after here today as well. But before we do sign off, let's take a quick look at the 10-year, which is, moving up a little bit. So, this would speak to like what Logan Motorshami over at HW has said. It's like, it's going to be really hard to stay below 3.7, 3.8 rate. And we're nearing back up to 3.8. I think we all appreciate it when we're at the 3.6 level in the 10-year. But this 10-year now ticking back up. Could even see, now that we're a couple days out of the celebration of what the Fed did last week, you could even argue that the 30-year fix could pop a little bit. That's why it was so aggressive leading into that meeting of like, get the buyers to understand the opportunity they have right now. I'm not saying going back up to 6.5 or anything. The weekly last week came in at the lowest level we've seen basically a couple of years at 6.09, and 6.15 was the reading for last week. Just a quick, like, early 45 days out look at the CME. Basically a coin flip between half point and quarter point. Fed says they expect to do another half point reduction between now and the end of the year. There's 2 meetings. So, you could see, basically, you've got what do you have? You've got 2 meetings left. So you've got November and then the very end of December, November 7th, and then December 18th. So that would mean, hey, probably quarter point, but CME Group's kind of giving you a toss up here, 50-50 chance that it's a half a point. Obviously, we did, when I show these charts, I remember we did have one comment said there will be no cut. Obviously, I apologize to that hot sheet, was obviously not right there. We saw the half a point. So listen, I think it's interesting that it's a half point. We had some that, thought it would be 0 or many that thought it'd be a quarter, and for it to be a half point does show us that there's some major concern about the job market. One thing I'm concerned about for you is if you haven't gotten your ticket to BAM Mania, you need to do it this week. VIP, I'm hearing, will be sold out at some point this week. The VIP experience. BAMX members, you get 25% off of your VIP ticket as being a member of BAMX, as well as general admission. Make sure that you sign up as soon as possible so you don't miss this event coming up in October 17th and 18th for VIP attendees, October 18th for general admission attendees at Circa Las Vegas. Every attendee gets access to our kickoff party on the 17th, as well as our after party on the 18th. BAMmania.com to grab your ticket. Make sure you do it. Obviously, also, I mentioned earlier, BAMX members, big announcement coming with Zudilio here in a week. So a lot going on, busy week. Glad to be back with you. I'll be with you guys all week. And until tomorrow morning, have a great day. And of course, toodaloo.